today. My name is Kasim and welcome to my YouTube channel. Today's video we're going to talk about a stock. What is a stock? We're going to break everything down all the way to the minute details. I want to just explain everything to you. So let's get into the video. I hope you've been enjoying all the content that you've been getting on my YouTube channel so far. Please take a moment to subscribe, like some of my videos so it gets pushed out to other people by YouTube. Thank you very much for doing that. I appreciate you. Thanks. Let's get into the video. In the simplest form, a stock is a piece of ownership in a company. When you buy a stock, you're buying a piece of ownership, like you own the company. If you buy Apple stock, you're buying a piece of it. You're owner of Apple stock, right? So that's what we're doing today. We're talking about how all this stuff is coming together. I'm doing a series of videos just explaining these topics. So it's in a presentation form right now. So you go out and you open a company and you divide your company into 100 pieces, right? So this is 100 stocks. That's the total amount of stocks that you have in your company. And so let's say if I come in and I buy this top right here, then I become a part owner of the entire business, right? So I own a piece of the entire business. That's what I'm trying to get to you in this video. Let's say you go out and you purchase 10 stocks in the company. And what you do is you divide the total amount of stock that you buy by the total amount of available stock of the company. Then it gives you 10%. So this shows that you're a 10% owner of this company A right here. So the other confusing term, confusing words that people get messed up when it comes to investing is stocks and shares. They're basically the same thing. So when you have a stock, is like you own shares, right? You own a stock is the name of what you have, and shares are the piece of what you have, I guess. That's how I can kind of present this information to you. A stock is what you own, shares is pieces of what you own. So that's what that is. So what's the whole point of a stock, right? What's the function of it? So whenever you go out and you raise money or like you sell shares of your company to investors, you're basically raising capital. You're raising money for you to be able to put into your business for it to grow. Like an example of this would be something like Elon Musk and Tesla. When Tesla first started, they started as a private company, and then they see the potential in what they're doing, and they decide to go to the stock market and sell a piece of their company, sell their company to the stock market to raise money so they can put that money back into their business. So that's one of the key function of stocks in our economy. So it provides a way for companies to go out and actually raise money to be able to put into their business and make it grow. And at the same time, it provides liquidity to investors. And if you look at the term liquidity, it just simply means it's easy to sell what you own. Like if I compare stocks to real estate, for example, the liquidity in real estate is not really quick. The liquidity in real estate is not really as quick as the stock market. Like in the stock market, you can buy a stock today, hold it for 2 days and decide to sell it. But the same thing if you go to real estate. I'm just explaining liquidity. If you look at real estate, let's say you buy real estate today and you decide to sell it like a month after, you won't be able to sell it right away. It takes this process that you need to go through in order for you to be able to actually sell that real estate. So this is what liquidity means in this presentation. This is an example here. Let's say you have a situation whereby your person, you're called Bill, you decide to open a cell phone company, and you need 100,000 for you to start the business, but you only have 60,000. then what you could do is you could decide to, go and sell a piece of your company, right? So you need 100,000, you have 60, so you need 40 more percent. You can go out and pitch your idea to someone, and then someone can just say, okay, you know what, I'm going to invest 40,000 and I'll own 40% of the company. So that's the idea of raising money. That's how raising money works in the stock market and in the economy. So in order for you to raise the money, you decide to form a corporation, and you want to go out and sell 100,000 shares. So let's say the 100,000 shares is going to be $1 a piece, and then you go out and you sell it to the public, right? That's how companies go public. They decide to go public. They follow the paperwork with the authorities, and then they say, okay, we want to sell a set of amount of our shares at this price to the public. Here's a better picture here. You have the person that is starting the business. In this case, I named you Bill. You have $60,000 invested, which is your savings, and that means you have 60,000 shares, because remember, you're going out to sell 100,000 shares to the public. You have 60,000 shares. Then you obviously form a corporation, and you get investors to invest 40,000. So now they would potentially have 40,000 shares, and that can be your friend, that can be a family member, that can be whomever, So on the other hand here, that means you, like I said, will have 60% of the shares out of you will have 60,000 out of the 100,000. You own 60%, and then your friend, the investor, whomever, will own 40% of the company. So now once you raise the money, the 40,000, you put it together with one that you have, and you use it to start the business. Now if you go and you start the business, and the business is successful, and let's say 5 years, 10 years into the business, your stock goes up, then you want to sell it for a profit, and that's when the stock market comes in. It provides that liquidity. There's a bunch of people in the stock market that buy and sell stocks on a daily basis. So this is why this concept of owning stocks and shares is very important to kind of grasp. It's just a way of raising money, and other people can own your business. So like, let's say if you go out and buy Apple stock, they already went through this process. So you go out, you buy their stock, and you become an owner. If they pay any dividend, you get paid. If they have any issues that they need shareholders to vote on, you get the ability to vote. All these things. This is what you get with investing in the stock market. That's what a stock is. So let's say you go through the process. You raised $100,000, which is what you need. In turn, you have 100,000 shares of your company, and each of the shares is worth $1. So your company is worth 100,000, right? So if, let's say, in the future the price goes up, which will be the next presentation I'm going to show you, if in the future the price goes up, then you can sell a piece of your company to other investors as well in the market. A year or 2 years or 3 years later, like we've seen in companies like Beyond Meat and all this stuff, if you have a good product and you're offering your business is something that makes sense, like a Facebook, like a Apple, like a Beyond Meat, something that is different, that's changing the world. So let's say that's what you have going on, and you've raised, remember, like the shares that you had when you started the business was $1, right? So let's say 2 years down the line, 5 years down the line, your stock is now priced at $60,000. Now the shares that you own in the company has basically 60 times, right? So now, being at this point, you can decide to sell a little bit of it to the public, and the way to do that is just to go through the stock exchanges and be able to sell your stock to the public. So if you go back to the previous example whereby I showed you this part of this presentation, we go back to the previous example and you see that, okay, you started with 60,000 and you got investors to, give you 40,000, and your shares was at $1 at this point. So fast forward, let's say 3 years later, 5 years later, now your stock is going at $60, and you want to sell 1,000 shares of those to new investor. So you sell the shares to this new investor, and the new investor will pay you the current value of your company, which would be 20,000. So that's what stocks provide. It provides you with the ability to be able to sell your stock if you need really quickly, and it's just a very liquid market. Is much liquid than real estate or owning gold or anything like that. It's a very liquid market. Stocks are very liquid. So after you sold that to the investor, right, you got paid 20,000. So that means you still own 59% of the company, and the new investor will own 1%, and then your friend still own 40% of the company, right? And that's the friend that you initially started investing with, that you raised money with, right? So that's basically how stocks work. That you still would own a lot of the company, but then you have this new investor that bought the stock from you at a higher price. Because when you started the company, you just basically created the stock by starting the company, and now the company is more valuable, and this new investor now is paying you a higher price for your own company. To recap, like when you buy stocks, it basically equals to you buying an ownership in a company, right? You own a piece of the company, and you're entitled to whatever the company is giving to everybody else. So if the company is paying interest, if they're paying dividend, if they want to decide to split the stock so they have more stocks available for the public, whatever the company decide to do, you're going to benefit from that directly, basically. To close everything up, this is exactly what I'm trying to do here with my portfolio. All these companies, we all know them, and they all pay dividend. They're out there having their business. They're in business, like they're selling stuff to people, they're buying stuff, they're producing lots of good in the economy, and all these companies, they're out there working, and I'm basically just here benefiting from their growth. So if the company go higher, I can sell it at a higher price, and if the company pays dividend in the meantime while they're going up and down, I collect interest, I collect dividend from those companies. So that is exactly what I just explained to you. FedEx, we all know FedEx, we all know Citibank, we know General Motors, we know Foot Locker. All these companies are out there doing business, and we benefit from their growth, right? Their growth when they grow up in price, or like when they pay dividend, like Apple pays very good dividend, a very safe company. So yeah, I hope you've enjoyed and find value in this video. If you do, please like and subscribe to the channel. My goal is to bring valuable content and just break everything down and just make investing as easy to understand as possible. Please bear with me with all the quality issues. I'm going to be working on my YouTube as I go. Thank you very much. I'm still new to YouTube, so please subscribe to support my channel. Thank you and have a good one. Bye.